Hello, everyone. Today, we will talk about cash flow estimation or projection and a simple valuation process using historical financial statements. As you can see on the screen, we have financial reports or historical financial statements from 2017 to 2020. We have the balance sheet and income statement for the last 4 years. So the first process here is we'll make projections or cash flow estimations for the next, let's say 10 years or 5 years or 10 years or however long you want to go. Of course, the shorter projection has a higher likelihood to be more accurate. But again, we are not saying that shorter projections are always more accurate than the long projections. But no, the likelihood, you can imagine, right? If you make a projection for a shorter term, maybe next year or the next 3 years or 5 years, they are more likely to be more foreseeable, but more predictable than another projection for, let's say, 10 years or 25 years or sometime longer. Okay, so if you look at the balance sheet and income statement, we know that the first account or item to be projected would be the revenues or the sales. Just the key to all subsequent projections, because again, whenever we are doing business, the first process would be to sell something, right? Okay, we are making something, goods or services, and then we sell them. That's the key to any kind of business, right? To make money, to sell your goods and services. So we have many sheets that I have prepared to make it easier for you to learn, to see this simple example. So again, if we have like income statement and balance sheet and cash flow statement from the past, and we want to make a projection, then again, the first item to estimate or project would be the revenues. Okay, so let's go to the third sheet here on this Excel file. So we got this kind of like revenues from the past, from 2017 to 2020, and we also got the breakdowns. We had the details. So the company has 4 products in this example, and how to make the projection for like 2021 to 2029 in this example. There are many methods, right? There are many methods. The easiest would be the like averaging that we are going to do today. There are other methods that you could always consider. For example, regression method, regression technique, where you could make a projection of future sales as affected by a series of independent variables. So you have like several independent variables that affect the future sales, and you could do the regression. You get the coefficients, beta coefficients for all the independent variables. Then you put into the estimated numbers of those independent variables, and then you could get the projected sales for that particular year. So you could do the regression method, right, with independent variables that you take on or you decide based on literature or other observations. You can do like another method like trend analysis. So trend analysis is basically regressing on the time. So when the time passes, the revenues will also increase, right? Because it's a function of time. So we call it the trend analysis. So in this example, I try to be more straightforward and simple here. So we have 4 products, and we could make, for example, for each product here, like product 1, product 2, and so forth, we can estimate each of them based on the estimated sales volume for subsequent years and the estimated prices for subsequent years and so on. But again, for this example, I'll just do the a simpler method, a more simple method, which is the averaging. So let's, for example, take this one, the first product here. What is the growth rate for the last maybe 3 years? 2017, we don't have any comparison. We don't have the previous amount from 2016. So obviously we have to start from 2018. So what is the growth rate in 2018 for product 1? This would be, you can see here, product 1 here, the sales in 2018 minus the sales in 2017 divided by the sales in 2017. So we get 20.31% and can do the copying and pasting for the first product, and actually the patterns are the same. So we could make again copying and pasting for all the products here. Okay, so essentially we got here the growth rate in 2018, the growth rate in 2019, the growth rate in 2020. It's just the growth rate of product 1, right, in 3 preceding years, and then the second product, the third, and the fourth. Okay, so for the next 10 years, what would be the growth rate? So this is an arbitrary decision. So you make your decision. If you want to use the averaging method, you could use, for example, the growth rate of the last period, like 14.19, or you could use the averaging. Right, 14.89%, and you could maintain 14.89% for the next 10 years, right, if you want to do it. Or another way, if you look at the pattern here, it's like 20.31 going down to 10.17 and then going up at 14.19%. This shows like inconsistent growth rate. So if we use a single average based on the 3 preceding years, it might be less, how to say, like less convincing, or maybe less consistent for the future years, subsequent years. So in this example, I will just use the moving averages. Okay, moving averages. So we do the averaging here. Okay, but see, for 2021, the average of growth rate is 14.89, because that's the average of 20.31, 10.17, and 14.19. But for 2022, the averaging would be these 3. The averaging of the preceding 3 years, the last 3 years. So we call it moving averages. So it's not a single average based on 2018 to 2020, but the averages keep moving. So for 21, this is the average of 2018 to 2020. For 2022, that's the average of 2019, 2020, and 2021. Right, so I just make a copying and pasting. This is the moving averages that we can see here. For example, 2022, this is the average from, what was that, 2019 to 2021. For the estimate for 2023 is the average of 2020, 2021, and 2022, so on. So it's the same pattern, and make a copying and pasting. Okay, so we use Yeah, we use the moving averages. Okay, moving averages, because if you look at their growth patterns, they were quite inconsistent. There was no continuous pattern. Right? It's going up and down. So we used the moving averages. Okay, so knowing their or estimating their growth rates of the four products, then we could, essentially we could estimate what would be the revenues, right, in 2021 for product one, right? So this would be the previous year, okay, growing by 14.89%, right? So it's growing, yeah. So the same thing here, we just do a copying and pasting, the same pattern. So you can see here, for example, 2022, this should be the sales estimate in 2021 growing by this one, right, 13.09%, and so on. And once again, the same pattern here for all. Okay. Yeah, I try to use the like manual style of Excel coding and formula, rather than using the more advanced like data table or HLOOKUP, VLOOKUP, or something like that. Okay? So we are using the manual style of Excel. Okay, so we got again the growth rate projections, and then the sales projections for all the products. Then net revenues should be the sum of all the products here. Right, so same thing here, just copying and pasting. Okay, so essentially we just got the sales estimate, right? One of the key, key estimates for all of our analysis here, because the first item to project is always the revenues. And of course, in real life, this would be more dynamic and also more challenging, because the company might have a lot of product lines, product variants, and something like that. Can you imagine a automobile company, right? Transportation or vehicle company. Let's imagine the company is producing and selling many types of vehicles, from car, SUV, and then some other types of other product lines or types that they are selling. So we could have a lot of like product lines, and even each product line has to make its own sales projection. And of course, in a bigger company, sales projection is a serious thing, right? So if it's not conducting properly, then they might make like wrong decisions as to what to make, or how many to produce, or how many units to produce. So if the revenue or sales projections are really really vital, because that information would go back to the production floor to decide on the number of units and number of types to sell, or even to produce, and so on. So again, in real life, most likely we'll use more advanced methods like regression or some other programming, to estimate the sales. But for this example, it's not our focus today for the accuracy of sales projection, but we try to make the whole projection, like the whole company projection for the next 10 years, and do a simple valuation process. Okay, so we got the revenues for the next revenue estimates for the next 10 years. Okay, so next one, let's look at the assumption sheet. This is very, very, very crucial. Sales growth, we got it. We just made a separate sheet for revenues, like for sales. So we'll leave this one, blank. We don't need to fill that out anymore. So the next one is cost of goods sold. So cost of goods sold, CD, this one. So for cost of goods sold, the same thing applies here. We can use a lot of methods, maybe regression analysis. If you know the independent variables that will affect the future cost of goods sold, you can include them there based on literature, based on observations, or even some logical decisions or common sense. I could do the regression coefficient. In this example, try to make it easy by using the percentage of sales method. The cost of goods sold in our example here is determined by the percentage of sales method. And the cost driver is the sales. So let's look at 2017. So the cost of goods sold in 2017 as a ratio to the sales in 2017. Okay, so it's 86.56% in 2017, and we do the same thing for 2018, 19, and 20. Okay, if you look at the pattern here, right, there's no continuous pattern, ascending or descending. So it's quite, back and forth and up and down. So I will use the moving averages because they are not consistently going up or nor going down. So use the moving averages of the previous four ratios, right? The preceding four ratios. Right. So I do the moving averages for cost of goods sold. All right. Operating expenses. Look at the items here. Look at the next item here. Operating expenses. Again, you can use many other methods, regression analysis or trend analysis, or even we could decide that the operating expenses will grow by 5% from the preceding year, or many other methods, right? So we can decide that the amount will go up by 2% every year, by 1% or whatever. But in this example, I'll use the percentage to sales method. This is also common, right, in the real practice. So operating expenses are estimated using the percentage of sales method. So the cost driver here is again the sales. So 2017, right, historical operating expenses as a ratio to revenues, 9.18. Okay, this one is quite special. Look at the pattern here. It's descending, right? It's going down consistently. Hence, I tend to use the last growth rate, because if we are doing the averaging, it's not wrong, but look at the pattern again, right? It's going down, so continuously, or it's monotonously down, right? Downward. So in this example, I will just use the last growth rate as the basis for estimation for the next 10 years. Okay, so we decide, right? We decide each item. Okay, so look at this one again. Depreciation expense, we do it differently. I will show you in a little while. So depreciation expense is determined differently. Let's look at the next one. What else here? Okay, total operating expenses is this one. So what else? Operating profit. Okay, this one. Other income or loss, right? It's like extraordinary items. So other income or loss. Okay. Again, you can use many other methods. You can assume that the amount will remain the same for the next 10 years because you could say, the extraordinary activities, some positive cash flows or positive income, some negative income or loss, then they might balance each other out, they cancel one another out and so on. So you could say the amount is the same or similar for the next 10 years, or you could assume that it will increase by 1% per year, right? Or you can make another regression analysis for this item as well. So I'm using percentage of sales method, right, in this example. Other income or loss divided by revenues. So 0.78. So let's look at the pattern here. There's no clear pattern by going up and down, so we'll use the moving averages for the last moving averages of the last 4 growth rates. Okay. All right. Next item, the earnings, the operating profit. Then the next one, interest expense. We will make a separate projection for interest expense. So remember, we skipped this one, depreciation expense, and then also this one, interest expense, because both need like special projections, that's different or separate projections for the 2 items. And we get the earnings before tax, and this one, the taxes. So we follow the tax rate of the historical. So let's check for a while. The tax rate, we pay tax out of the earnings before tax. So let's look at what's the ratio between tax and earnings before tax or taxes. So 44. Okay, look at the pattern here is descending. It's minus because we are paying, right? Minus here means paying. So it's more proper to use the last than the last ratio, right? Because the pattern is descending, so it's not inconsistent, right? It's showing a descending, like going down pattern. So it's more proper to use the last estimate. But if you know that the tax rates to be followed in the future are certain numbers, then we can use the real projections or regulations. For example, if you know that from 2021 onward, the tax rate would be 21%, then surely you can just use 21%. Okay, but if you're not sure and you believe that the marginal tax rate could be higher, shown by the last 4 years, then you could use, for example, 30.27%. So again, projection doesn't have certain rules to comply with, right? This our own this arbitrary decisions by the appraiser, by the consultant, or by us ourselves as entrepreneurs and whoever or whatever entities making the projections. So in this example, let's use the last, okay? last figure, the last ratio, rather than 21%, because maybe they have like different marginal tax rate, and some other federal and state taxes. So for the purpose of this example, I'll just use the last figure. Dividend payout ratio, and this is the percentage of net income, right? Because we pay out dividends out of net income. So the information, dividends paid 2017 to net income. So we got the ratio here, 71 to and look at this one, right? It's going, it has a downward pattern. So it's better to use the last figure, last ratio. Okay, now interest. What's the interest expense? Actually, we can skip this one because we do separate the depreciation and the fixed assets and debt sheets. So we'll just skip this one for now, because we have a separate sheet for projecting or determining interest expense. Okay, so just let's continue to the balance sheet items. I think we are pretty much done with the income statement items. Now let's deal with the balance sheet items. All right. Look at the balance sheet items here. We have many items to estimate or project that for a few subsequent years. Let's look at this. Okay, one moment. Yeah. So accounts receivable. The estimate for accounts receivable. We find out the first we need to make the cost driver at the day sales outstanding. Day sales outstanding. Let's find out. This is what accounts receivable divided by daily sales. Right, accounts receivable. Okay, accounts receivable. Yep, divided by daily sales. Daily sales in 2017. Okay, so we get 58.73, and okay, so let's look at the there's no consistent pattern here, going down and then going up. So we do the averaging. Moving averages of the last 4 ratios. Days inventory held. This is about inventory. Projecting the inventories using the days inventory held as cost driver, as the driver. Sorry. So inventories divided by daily. So this should be divided. So inventories divided by daily cost of goods sold. Check here, inventories 2017 divided by daily cost of goods sold. Right. Okay, now the pattern is downward, right? They continuously downward. So I will just use the last ratio other than moving averages. Okay, the next one, days payable deferred. Days payable deferred, is accounts payable divided by daily cost of goods sold. So accounts payable here, yeah, the current liabilities, accounts payable divided by daily cost of goods sold. Right? Yeah, it's again we see inconsistent pattern going up and down. So it's better to use the moving averages for this one. Moving, the average of the last four ratios. Okay. This one, we have a separate sheet that we are going to see in a moment. So the interest, then the fixed assets growth, depreciation rate, then this one also, bank payable and long-term debt. We'll have separate sheets for those two items. So essentially, the two items there, the something related to fixed assets and something related to debt or liabilities, especially long-term liabilities, are conducted separately in separate sheets. The next one, what is the constant growth forever? Later in the valuation process, we need this indicator or this input, constant growth forever, after the end of our analysis period. And we're saying here 1.5%. We could argue this is the typical economic growth, annual economic growth at 1.5%. But in real life, this could be like part of our research to determine what would be the constant growth forever of the company or the project or any kind of entity after the analysis period ends. The outstanding shares, 1.5 million, 1.5 million shares in this example. Okay, it's pretty much done for this sheet, but remember we still have like two separate sheets, right, related to fixed assets and debt. Right. So here the sheet is called depreciation. A depreciation sheet here we have information on gross assets, and then the depreciation expense for the last 4 years, and of course the accumulated depreciation and net assets. So let's imagine this one, like gross assets. Yeah, what kind of growth rate will the company or the project have, for the next 10 years? How they procure new assets or replace the old assets and so on. So in the real life, this would require quite a tedious work because we need to map. For example, we need to have a list of fixed assets, existing ones, right? The existing fixed assets. For example, I don't know, maybe you got 25 machinery, 25 equipment, and when did we get it? We got it in many different years, right? For example, in 2012, 2013, so we got like 2, we got 3, and so on. Okay, you can imagine, right? So we could make the real list, right? List of like equipment or fixed assets and so on. This will highly affect the depreciation expense for every year Okay, imagine for example, we got the two equipment in 2012 that would be depreciated for 10 years, meaning that yeah, it would be depreciated up to 2022, right? And in 2013 we got three equipment. One of them would be depreciated for 5 years. Another one would be depreciated for 10 years, and the other one would be depreciated for 20 years. You can see can imagine that. So the real process would require the details of fixed assets that the company or the project has. Okay, so we have existing, and then we have the upcoming or the planned purchases of fixed assets. For example, if you know that in 2025 you will procure a new vehicle, a new anything, right? New equipment, new machinery, and so on. And it will be depreciated from 2025. So we got it at 2025. It will be depreciated from 2026 to or for the next 10 years, for example. Right? So we have existing assets that are still depreciated even until today. And we might have like upcoming assets if we know that in certain years in the future, you will procure new assets and so on. But in this example, because again, I think our main focus is to learn about the basic of projection rather than the accuracy or the real life process of the fixed assets projection. We'll just use, I think, the growth rate, historical growth rate. So I'll put it here, fixed asset growth rate. One moment. So we don't have 2016, so we have to, the first growth rate that we could estimate is 2018. Go back to assumption here. So 17, we don't have a 2016, so I'll begin here. 2018, the growth rate would be this one, right? The gross assets in 2018 minus gross assets in 2017 divided by gross assets in 2017. All right. So we get 812, 934, 877. What would be the growth rate of the gross assets in the future? Again, this is the method that we choose. It's by no means the by no means exhaustive, in terms of the choice of method, because you could choose other methods. Again, maybe real projections, real information that you got for the future years, right? The purchases, procurement, and other things like the retirement of equipment after certain years and so on. But here we don't have that real information, so we are making assumptions. I will just do the moving averages for the growth rate, the last three figures. All right, from this fixed assets, the figure here, we can make the the number later. And we can decide, we can make the estimates based on the growth rates that we just projected. So depreciation rate, we can use the depreciation rate as the percentage of gross assets. So in 2017, this is the depreciation expense, and this is the gross assets. So 352 to 434. I see the pattern there is in the uptrend pattern. Again, we are using this method, right? The depreciation rate as the percentage of growth fixed assets. In real life, once again, we have to determine the existing fixed assets that are ongoing. We bought it in, again, 2012, 2014, 15, and so on, and they're still ongoing. They're still being depreciated even until today. Then we can find out, right, the real depreciation expense for every year, and also for subsequent years. We might have the upcoming, the new procurements of fixed assets. Then all the numbers will add up, will combine to constitute the depreciation expense. But we are not doing the detailed method, so we are using the percentage of gross fixed assets. Again, in real life, this might not be the most accurate method to describe or to estimate depreciation expense, but for the sake of brevity in this example, we'll just use the percentage of gross fixed assets. And again, see the pattern there upward. So we just use the last figure. Okay, so we're pretty much done for this one. And depreciation and debt, maybe we can estimate it now. So gross assets in 21, 22, and so forth should be the gross assets in 2020 going by this one, right? The growth, 2021. Where's 2021? Here. Okay, and we are making a copy and paste. Okay, so previous year times 1 plus the growth rate, the estimated growth rate. Okay. Then the depreciation expense. Then depreciation expense, we maintain the ratio. I see here depreciation expense. We got the ratio here. This is depreciation rate 2021. It's 4.34% of the estimated gross assets in 2021. All right, so it's once again it's 4.34%. Right, the depreciation rate, the projected depreciation rate in 2021, 434, divided by the projected gross assets in 2021. So same thing here. We make copying and pasting. Okay. So accumulated depreciation. Accumulated depreciation is essentially the accumulated depreciation from the preceding period plus the depreciation expense in that particular year, right? So cumulative depreciation from the previous year plus depreciation expense in that year. Okay, same pattern. And the next, net assets. Net assets would be the difference between gross assets and its accumulated depreciation. Gross assets minus accumulated depreciation is your net assets. Okay, so we're pretty much done with the fixed assets sheet. Okay, this will be very helpful when we plug everything into the projection. Okay, so the other sheet that we have to complete is the separately. I mean, it's debt, right? The sheet for the company debts or liabilities, long-term liabilities. So we figure here that out of the balance sheet, right, the historical balance sheet, we figure out that there are only two items that are interest bearing, right? So there are only two items, two liabilities items that are interest bearing: bank payable and long-term debt. So we put it here, bank payable and long-term debt. So let's look at this one, bank payable. Look at the previous, what's that pattern? Okay, so yeah, you can do many styles of projection. We can determine the growth rate, what we did before, right? Or you could simply make the here. Yeah, you could say that this would be the average of previous debt amount, because some would be paid out, some would be repaid, some would be added. For example, the company every year the company will borrow, like will get new borrowings, but they will repay the old debts. So the amount might be similar. The amount might revolve around a certain number. So you can, again, there are many methods. For this example, maybe I'll just do the moving averages, but not moving averages of previous growth rates, but moving averages of the previous amounts. This is even more simple, right? So moving averages of previous amounts for the last 4 years. Again, this is by no means the best method or anything that we could claim, but there are many other methods. For example, the growth rate method, or moving averages of growth rates, or any other method, regression models, and so on. But again, I think we could argue here that some amounts would be repaid, some would be added, right, in subsequent years. So it will be around a certain number, right? So we're doing the moving averages of the last 4 years, amounts for the last 4 years. Long-term liabilities, if you look at the pattern here, for this example, I'll just assume that we'll stick with 195,000 to 195 million, following the last figure, because again the trend is increasing, it's uptrend. So interest expense, let's say the ratio, find the ratio, okay? Interest expense of, percentage of interest bearing liabilities. Okay, so this one, the interest expense in 2017 divided by interest bearing liabilities, which are only two. Okay, and we might want to maintain the ratio, but again, the pattern is inconsistent. So I will do the moving averages. Right. And based on those estimates, we come back here. So interest expense in 2021 should be here, the ratio estimate 2021 times the interest bearing liabilities or debts in 2021. So again, there are two. Okay. So the ratio, the estimated ratio times the projected interest bearing liabilities in 2021. So we got the estimates, the projections. All right. I think all assumptions are pretty much completed, right? With the cost drivers or the drivers. Now we can start making the pro forma, right? The pro forma income statement. We'll start with pro forma income statement. We just put in all the numbers that we have projected so far. Revenues 21. So remember we have a specific sheet for revenues for sales. 21 should be this one, right? Okay, and we just do the copying and pasting. Cost of goods sold. Oh wait, cost of goods sold. Okay, we need this one. So we have the ratio, right? Percentage of sales. That's the driver, right? So the ratio to what's that? Percentage of sales, ratio to sales. So 7.08 in 2021 times the sales, right, in 2021. Okay. Oh, sorry, this might be wrong. So percentage of sales. Sorry, I think it's wrong line. Let me repeat. Cost of goods sold. Sorry, yeah, should be 86.17. 86.17 times the sales estimate in 2021. Yeah, it should look like this. Okay. Okay, then we got gross profit. Again, gross profit is revenues minus cost of goods sold. Okay. Operating expenses. Again, we follow the the projected ratios. Operating expenses. It would be operating expenses in 2021. Yeah, this one. Operating expenses. Times the revenues of 2021. Depreciation expense. I think we did it here. Depreciation expense in a separate sheet here for fixed assets or depreciation. We just need to link it to a specific sheet. So depreciation expense in 2021. Where is it? Here, this one. Okay. Okay. Total operating expenses. This is the sum of these two. Okay. Operating profit. Operating profit is gross profit minus total operating expenses. We get the operating profit. Other income or loss. I think we have the projected ratios. Yeah, this one. Okay, this percentage of sales. So other income or loss in 2021. Be this one times the projected sales in 2021. And we got the earnings before interest and taxes. Operating profit. Yeah, operating. One moment. Yeah, it's plus, right? So this it's positive, so more income than loss for the extraordinary items. So plus the other income, right? Because it's positive, more income than loss. Right. Interest expense. Remember, we have a separate sheet, interest expense here. So we just need to link it to the other sheet, interest expense in 2021. This one. Okay. Okay. Earnings before taxes is of course earnings before interest and taxes. Yeah, minus interest expense. Yeah, maybe to make it consistent with the previous year, I just use minus here. Minus means we are paying, just to make it consistent with the use of sign. Okay, so actually interest expense, we saw a positive number, but it's because we are paying. Yeah, in this sheet, to maintain the consistency with like previous years, I would just use the minus sign also. So earnings before taxes is EBIT. Yeah, actually minus interest expense. I think you understand it. So the EBIT minus interest expense, but because the sign is already negative, so I'm using plus. So essentially, this earnings before interest and taxes minus interest expense. Okay, and then taxes again. This is in brackets, in negative sign because we are paying. Right? Taxes. I think we are assuming. Where is it? Tax. Yeah, tax rate. Yeah, I think we are following again the ratio in 2020. So just use the ratio here times the earnings before taxes. Earnings before taxes in 2021. Yeah, this one. Okay. Okay, net income. Because net income earnings before taxes minus taxes. But again, the taxes here are already in a negative sign. So yeah, the formula in Excel here is positive, but you understand, right? The net income is earnings before taxes minus taxes. Okay, and yeah, dividend payment. We got let's check. This is what 2020 is we have dividend payment. Yeah, dividend payout ratio. You look at here. So 55.06%. So do it once again. So just to make sure, it should be 55.06%, because we maintain dividend payout ratio from 2020 times the net income as projected net income in 2021. Okay, just to make sure, just do a copying and pasting. Okay, so yeah, we are done with the pro forma income statement. We'll go to the next one, pro forma balance sheet, the projected balance sheet. The same process here. We start from the one on the top. Cash and cash equivalents, we leave this out until we complete the cash flow statement, right? The pro forma cash flow statement. So again, for the first item here on the top, we'll leave it out until we complete the pro forma cash flow statement. So the second item, the next item here, short-term investments. Again, there are many methods. You could say that it will go by a certain percentage point, or you could determine your own amount if you know that in the future you buy marketable securities or certain financial assets, money market instruments, or something like that. In this example, because it's quite insignificant compared to other items, I would just assume that this would be no constant because maybe they don't, or even if they go in and out from the financial markets, the amount would be quite stable because the company might buy new investments, new short-term investment that they maybe the previous investments are sold or are maturing, could be maturing as well. Right? So I'll just assume that the amount is constant and it's not that significant. It's not that substantial anyway. Accounts receivable, I think we got the assumptions. Remember, we do it here, accounts receivable, using the day sales outstanding. So we got the day sales outstanding projected for the next 10 years from 2021 here. So just do quickly here. For 2021, it should be then the ratio. Day sales outstanding projected for 2021 multiplied by multiplied with the daily sales in 2021. So daily revenues 2021. So the projected day sales outstanding in 2021 times the daily sales in 2021. Okay. Inventories, I think we got the assumption as well. Inventories here using days inventory held as the basis. See the ratio in 2021. So we do it here. So the projected ratio for 2021 times the daily cost of goods sold. Cost of goods sold daily. Okay, the ratio times daily cost of goods sold in 2021. Other current assets, if it's not substantial, you could assume that it's constant. Or another method is, of course, the percentage of sales. Right? For example, if you want to use the percentage of sales method, and you could here in 2020, so the ratio is right. Maybe I use go back here. Other current assets in 2020. Okay, divided by sales in 2020. Okay, times the sales in 2021. Right? But be careful because we are doing the copying and pasting to the subsequent periods. Be careful that the ratio here, we don't want to do the moving averages, right? So we have to lock it here. Right? Have to lock it with the the F4. Right? So we lock the two cells there because we are not doing the moving averages, so the ratio is maintained. But but the cells are moving, right? The ratio is maintained, but the cells are moving. We'll do it this way. Okay, and current assets is the sum of all from cash to other current assets. But again, we haven't finished the cash and cash equivalents. Not until we complete the pro forma cash flow statements. So let's continue now. Net fixed assets. I think we got it. We got it here. In the depreciation sheet. Net fixed assets 2021. Yeah, it should be this one. Okay. Other non-current assets, again, the amount is not substantial. You can assume that it's constant, or you can assume that it's going up together with sales, that percentage of sales method. Yeah, but maybe for this one, I'll just assume that it's constant throughout. Okay, so non-current assets, the sum of this. Total assets would be what's the total of current assets and non-current assets. Okay, so that's the asset side. So what about the liabilities and equity side? We'll do the same thing here. Accounts payable. Remember accounts payable, we got the assumption. Days payable deferred. Days payable deferred. This is the driver for the accounts payable. So for 2021, it's the ratio days payable deferred in 2021. This one times daily cost of goods sold. So daily cost of goods sold. Okay. Bank payable, I think we got it in a separate sheet, right? The debt sheet, liability sheet, or yeah. So bank payable. $21. Other current liabilities, again, it depends on how you want to assume, right? You can assume there's constant throughout the analysis period, or you can define it as the percentage of sales, right? As a percentage of sales. So we do again the other current liabilities, and we lock it because we want to maintain the ratio. We only have one ratio and we want to maintain it. 2020 as a percentage of sales in 2020. And we lock it also. Okay. Multiplied with the sales in 2021. Okay, so we maintain the ratio, but the the revenues are moving, right? 2021, 22, and so on. Current liabilities is the sum of all the above items. Okay, long-term debt, we link to the other sheet, or the debt sheet. Long-term debt in 2021, yeah. Okay, yeah, constant. Other non-current liabilities, I would just assume that is not going together with sales, but is constant, because non-current liabilities are naturally decided, is decided by a careful thought, right? Because usually when you want to borrow money from a bank, issuing a bond, borrowing from another company, and something like that, you really ponder on it, right? You think about it, you will evaluate, analyze, and something. So we don't just go out and borrow instinctively or something, right? So it's a well thought process. So I would just assume there's the is constant throughout the analysis period. Non-current liabilities, right, the sum of the two above items, and total liabilities would be the current liabilities plus non-current liabilities. Okay, so the next one is the common stock. Common stock, if we have the real information, for example, 5 years from now, they will sell new shares or they will retire some treasury stocks or something, then those information, that information should be incorporated into the projections. However, here we don't have any real information, so it's safer to assume that the common stock wouldn't change. So it remains the same, right? Here we assume that there's no additional shares in subsequent years, nor any reduction in shares or treasury stocks being retired or something. Retained earnings is corporate savings. So we got it from the previous retained earnings plus the amount that the company wants to save in that particular year. So what is it? It should be the difference between the net income and dividend payout. So you can imagine that whenever the company makes money, right, earns a certain amount of net income, then the company has to make a decision as to how much to pay out as dividends. So the remaining amount would be saved as retained earnings, right? So again, retained earnings for 2021 should be retained earnings in 2020 plus the amount of savings that the company wants to make. So the savings would be the difference between the net income and dividend payment. Okay. So total equity, common stock, and retained earnings. And the liabilities and equity would be the total liabilities plus total equity. Okay, so we haven't solved this one. We haven't projected the cash and cash equivalents, but other items have been projected and put in place for the pro forma balance sheet. So the next one, we go to the projected cash flow statement or pro forma cash flow statement here. And we'll apply the indirect method for estimating the cash flows for the next 10 years. So we begin with net income or loss. We just need to link net income 21. Yep. Depreciation expense. Yeah, we link it also. Depreciation expense 21. So again, this is the indirect method of creating the pro forma cash flow statement. So net income, we add back depreciation expense. Right, we add back the okay, we add back depreciation expense, and now we make adjustments to the change in net working capital. Change in net working capital. Net working capital means the difference between current assets and current liabilities, or the involved items there. So net working capital means again the difference between current assets and current liabilities. So let's look at that one. What kind of what kind of working capital do we have here? Accounts receivable, right? Inventories. Then, yeah, other current assets. And what else? From the current liability side, we have accounts payable and other current liabilities. Okay, so yeah, it's not really complete, so we have to write down something there. Okay, let's start from the first one. So accounts receivable, right? Increase or decrease in accounts receivable 2021. So it should be accounts receivable 21 minus 20. So we got see the difference here. In 2021 it was it was 931,000, and in 2020 it was 783,000. So there was an increase. There was an increase in accounts receivable. Remember, in increasing accounts receivable will lower cash. Okay, so here, we need the minus sign, because an increase in accounts receivable lowers cash, right? Because now we sell more items we sell more items on credit rather than on cash basis. So increasing accounts receivable will lower our cash. So it's negative. It's negative sign. Okay, let's look at the next item here, inventories. Inventories, something here, inventories, sorry. Inventories in 21 minus inventories in 2020. And again, we are seeing an increasing inventories. And yeah, of course, if you had an increasing inventory, it means you bought it, right? You bought it. You didn't get it illegally. So we bought it, and to buy it, we needed cash. So again, increasing inventories will lower cash. Okay, what is the next item? Other current assets. It's the same here. Increase or decrease in other current assets. So other current assets, 21 minus 20. Again, increasing, but increasing other current assets will require cash payment. So then the relationship is negative, right? Okay, let's go to the right-hand side. Sorry, on the current liability side, we have accounts payable. We have accounts payable, and we have other current liabilities. Let's start from the increase or decrease in accounts payable. Accounts payable 21 minus 20. Okay, it's positive now. So you can imagine that an increasing accounts payable will add cash to the company, because now the accounts payable, how to say it, like you delay the payment to your suppliers. So more and more delays in your payments to your suppliers. So you can save money. So increasing accounts payable add cash to the company. Okay, that's why the increasing accounts payable is like has a positive effect on the what's that, on the cash flow, our cash flow. Okay, and I think we have one more item that where is it? Yeah, other current liabilities. Or decrease in other current liabilities. It should be 21 minus the that in 2020. So increasing, right? Increasing means you have more current liabilities. You save money, right? You save your cash because now you're adding more borrowing, short-term borrowings. Okay, I think pretty much done for cash flow from operating activities. We sum these. Okay, we got cash flow from. Oh, sorry. It's incomplete. So I should sum of all from your net income. We add back depreciation expense, and then we adjust. Yeah, we adjust this kind of what's that? Net working capital. Changes in net working capital. Okay. So the next one, cash flow from investing. Cash flow from investing activities. Essentially is capital expenditures, and let's see what we have here. Yeah, we have net fixed assets and other non-current assets and short-term investment. And so we start from the top one. So yeah, I know the amount doesn't change, but it's important to write here. Increase or decrease in short-term investments. Okay. So, yeah, short-term investment in 21 minus that in 20. Yeah, it's nothing. I know it's nothing, but yeah, it's worth doing, right? Because more systematic. So what else do we have? No more. Yeah, this one, right? The capex, right? The capex, capital expenditures. Just right here. Capital expenditures, and we have it in a separate sheet. The where's this? Oh, here. So the capex would be increase or decrease in gross fixed assets. Right, maybe it's worth doing. Capital expenditures. This would be the gross assets in 21 minus that in 2020. So there were purchases of gross assets between the 2 years. So think about it again, right? The gross assets in 21 was larger than that in 2020, meaning that there was there was a purchase. There was an addition to gross assets in 2021. Adding gross assets means you had to pay, right? You had to pay for it. So increasing gross assets lower the cash. Okay, so the relationship should be what? Negative, right? Negative relationship, because if you add more gross assets, you need to pay for it, right? You need to pay for them. We also have this one, other non-current assets that is part of the investing activities. So increase or decrease in other non-current assets. And 21 minus that in 20. Yeah, it's 0. It doesn't have any addition or reduction. Okay? So cash flow from investing, sum of the 3 items here. Okay. Next category, cash flow from financing activities. Financing activities, let's check. Financing activities would be bank payable, then long-term debt, other non-current liabilities, and common stock. Bank payable, long-term debt, other non-current liabilities, and common stock in our example. And then dividend payment. Okay, so increase or decrease in bank payable. Let's see. Bank payable in 21 minus that in 2020. Okay, look at this one, right? The bank payable was lower in 2021 than that in 2020, meaning that the bank borrowing, bank payable declined, right, in 2021, meaning that some part of the bank payable was repaid. Okay, so repaying your debt means you have the cash outflow, right? You disburse cash. Okay, so the relationship is positive. So if the amount decreases, it means that you pay something. If debt increases, it means you get some additional money into the company. Okay, okay? So the relationship between the debt and cash flow is positive, right? Increasing debt will add more cash, and vice versa. Decreasing debt or repaying your debt will lower cash. Maybe I'll move this one later. Make it more systematic. Okay, bank payable. Then let's check next one is what? Take bank payable. Yeah, long-term debt. Okay, increase or decrease in long-term debt. Once again, we're doing this. Long-term debt in 2021 minus that in 2020. And yeah, it's nothing. This we assume that the amount is constant. Next item, other non-current liabilities. Anything we're doing here, other non-current liabilities. Yeah, also nothing. Then common stock. There's no more on the liability side. Now common stock. $21 minus the 1 in 20. Also no increase nor decrease. Okay, and yeah, dividend payment. Dividend payment, you could find the information thing here. Yeah, 2021. And whenever we pay dividends, we pay something like using cash. So the relationship should be negative. Negative relationship between dividend payment and cash flow. Okay? We are paying dividends. And we just sum them up here. Cash flow from financing activities. Okay, so net cash flow at the beginning of period. So this is 21. The beginning of 21 is the end of 2020, right? Once again, the end of 2020 is the beginning of 2021. So 2021 here, where's the beginning period of 2021? Is the end of 2020. So cash in 20, yeah, this one, right? So the end of 2020 is the beginning of 2021. Okay, and cash in the end period would be the cash at the beginning of period, right? Plus oh wait, maybe it's better to do it this way. So net cash flow versus net cash flow. So yeah, I'll repeat later. Net cash flow should be the sum of net what's that cash flow from operating activities plus cash flow from investing activities and cash flow from financing activities. Okay, so we got the projected net cash flows for the next 10 years. And again, cash flow at the beginning of 2021 is cash flow at the end of 2020. All right, so cash flow at the end of 2020 should be the cash flow at the beginning of period plus net cash flow during that year. All right, so cash flow at the beginning of period plus the net cash flow during that year. And we got the cash flow, the cash at the end of period. So cash at the end of 2021 is cash at the beginning of 2022. See the logic there? So cash at the end of 2021 is cash at the beginning of 2022. Right. Okay, and then yeah, we do same thing here. Okay, what is the cash at the end of 2022? Yeah, it should be the cash at the beginning of period plus cash flow, net cash flows during that year. Okay, so yeah, we just continue doing this, right, and continue doing this. Okay, so we got the here we got the cash at the end of period that would be moved to our pro forma balance sheet. Pro forma balance sheet here. So cash at the end of 2021, just link it here. Cash at the end of 2021 would be this one, and so forth. Okay, here, check. Okay, so I think it's already balanced, right? These are the total assets, and what is it? Yeah, these are the total liabilities and equity. You can see they are balanced. Okay, so our pro forma balance sheet has been balanced, right? It's fixed after the completion of the pro forma cash flow statement. Okay, so this is the way to link the pro forma income statement, pro forma balance sheet, and pro forma cash flow statement. Okay. So I will continue our process a little bit more with valuation. Okay, valuation, simple valuation process here. And firstly, we have to now estimate one of the major inputs, which is the cost of capital. Again, in this video, I'm not focusing on the discussion on the cost of capital. If you're interested, you can watch a separate video on the cost of capital that has been provided as well, where we just go through the estimates and we come up with the valuation method. So let's imagine here cost of debt. For example, we have cost of debt. If you are going to borrow money from a bank, or if you're going to issue a new series of bond to finance a project or finance a company, let's say it's I don't know, maybe right now say 10.25%. Okay, tax rate 21, depending on your country. Maybe 21, 22. I'm just using 21. Okay. So the cost of debt, the after tax cost of debt would be 10.25 cut by tax. Okay, so it's about 8.10%, right? The after tax cost of debt. What about the cost of equity? Risk free. I don't know. You can find the yield on government securities rate. Yeah, the yield on government securities, whatever. For maybe 10-year maturity or 20-year maturity, depending on the project that we are talking about. But essentially, this is the yield on a government security that could represent the nature and the length of the company or the project. Let's use 625 something. Beta, yeah, discussion on beta is discussed on the portfolio theory, and then the cost of equity materials and videos. If you're interested, you can review the videos on portfolio theory, and also the cost of equity or cost of capital generally. So just assume that the beta is 1.1 for this example. Essentially, beta is the sensitivity between individual assets or individual projects return to the market return. Risk premium, let's say for the last, 15 years, it's 9.75%. A geometric return on a certain stock index for the last 15 years, let's assume it to be 9.75%. Now the cost of equity using the capital asset pricing model. Capital asset pricing model. Again, we are not focusing on the cost of capital, so I'll just try to be quick here, right, to estimate the cost of capital. If you're interested, review the video on the cost of capital. We talk in details about cost of debt, cost of preferred stock, cost of equity, and how to estimate beta and some other things there. So this example, I'll just go through it quickly. Cost of equity using the CAPM, like capital asset pricing model, should be the risk-free rate plus the oh, maybe I have to be careful a bit. Let me do it more properly here. So okay, So market return 975 and risk premium. Let's do it more properly here. So risk premium should be the difference between the market return and the risk-free return. Be more precise, market risk premium. Okay, so the CAPM using the cost of equity using CAPM to be the risk-free rate plus beta times market risk premium. So we got 10.10%. Right, and what is the capital structure? The proportion of debt and equity. Let's find it quickly. Let's use the amount in, could be in 2020 or in 2021. If we position ourselves at the end of 2020, it's more proper to use the capital structure in 2020. So it depends on how you see it. So just use the one in 2020. So liabilities, total liabilities in 2020 divided by total assets in 2020. So 73.69% was debt, meaning that the equity should be the remainder. Let's see it probably. Right. It should be 1 minus this. Okay, so 26.31% equity. So cost of capital, 73% debt, right, times the cost of debt plus 26% equity times cost of equity. Okay, so we got 8.62% for the what's that, for WACC, for the cost of capital, weighted average cost of capital. Then we can go to the next page quickly here. So we have estimated the cost of capital, and we have so we have two valuation methods, right? Free cash flow to the firm and free cash flow to equity holders. So start with the free cash flow to the firm. So how to estimate the free cash flow to the firm? I'll just do it here quickly. Okay, so free cash flow to the firm. Free cash flow to the firm is your earnings before interest and taxes, cut by tax. We call it NOPAT. Then you, add back all kind of necessary things. For you, add back depreciation expense. Okay, minus capital expenditures. Then you deduct the change in net working capital. Right, change in net working capital. Then what else do you need? Do you add the terminal value or horizon value, if any? Okay, and then you get the free cash flow to the firm. So essentially, that's the what's that? The free cash flow to the firm. So we go back here to see the details. Okay, so EBIT, let's see the formula again. All right, we start from the EBIT, earnings before interest and taxes. And we have it somewhere, the income statement, pro forma income statement, your EBIT here. maybe 2021. Yes. Okay. And okay, 2029. Afterward, wait. Okay, and then the taxes paid. Then go to the here taxes. Okay. So, okay, NOPAT is the again the after tax operating profit. So EBIT, just use some cut by tax. We call it NOPAT, net operating profit after tax. Once again, it's net operating profit after tax. But NOPAT. For this, I think just delete this. And yeah, depreciation expense. The depreciation expense, just get it from anywhere. Cash flow statement or income statement should be the same. We just copy it from the here. Depreciation expense. And thing to be careful here, depreciation expense is we add it back. So it's a positive, right? So we add back depreciation expense. Capital expenditures, we can get it from the cash flow statement. Capital expenditures. Yeah, just use all the like cash flow from investing activities. All right. So minus, right? Negative relationship. Spending for what's it? Investing activities. And then change in net working capital. Again, we can get it from the cash flow statement, pro forma cash flow statement. Yeah, essentially all of this, right? All of this. So it's the sum of this. All right, the change in net working capital. Okay, so it's the total is negative of this. Okay, now horizon value. This is quite yeah, we can make it more detailed actually if we want. So essentially we are asking. You see, like we make a projection for the next, I don't know, 10 years, I guess, like yeah, 9 or 10 years, and what will happen after the 9-year period or 10-year period? If the project is ongoing, then we need to estimate the horizon value of the project. But in another case, for example, you're projecting a certain asset with an economic value of 10 years. Then of course, after the end of analysis period, the asset would be scrapped. So there will be no more horizon value. Maybe there's a salvage value, right? The scrap value a bit, but there's no horizon value for that case. But in a common case where we are valuing an asset, an ongoing asset beyond the analysis period, then we need to estimate the horizon value to represent the value beyond the analysis period. So you're asking what is the contribution from years 11, 12, 13, 14, 15, and yeah, until infinity, right? We need a horizon value. So how to estimate the horizon value? So horizon value, one moment. So the horizon value would be the cash flow, next cash flow, horizon value at time t should be the next cash flow, right? Time t plus 1, divided by the cost of capital minus the constant growth rate forever. Constant growth rate forever. And I think in our story here, the constant growth rate forever is 1.5%. But the question is how to estimate this one. Right? So the easiest way would be the free cash flow to the firm at the time t at the end of the analysis period, growing by the growth rate. Okay, so we could write it this way. It's not a clean estimation. Actually, a cleaner estimation would be if we have another year of estimate, and it will be much better if we have an estimate in 2030 and we estimate the cash flow for 2030 or 1 year after the period. But for this one, we didn't make any projection for 2030. Yeah, we could add one more if we want, but let me see. Yeah, on all until 29. So we don't have the projection for 2030. So what we can do is again the simplification. Okay, so horizon value here, we're assuming that will be the cash flow in 2020, which is this one, the sum of NOPAT, add back depreciation. One moment. So NOPAT plus depreciation minus the capex minus the change in net working capital. Okay, so we get the cash flow from 2020 growing by 1 plus this one, growing by 1.5%. Okay. Divided by, what's the cost of capital? Cost of capital is this one. Cost of capital is 8.62. Minus the constant growth forever. Okay, so we got the what's the horizon value? So once again, horizon value represents the values or contributions beyond the analysis period, right? And do it with this one, right? The next cash flow divided by the WACC, the cost of capital, minus the constant growth rate forever. Okay, then free cash flow, yeah, and this is the sum of NOPAT. Okay, NOPAT, we'll add back depreciation expense minus capex minus the change in net working capital plus horizon value. Okay, so we got the projected cash flows for the next years, 10 years, 9 or 10 years. Okay, now what is the present value? Cost of capital is, let's connect it here. And this is the cost of capital. So what's the present value? Our cash flow divided by 1 plus the WACC to the power of, oh, okay, I need to make imaginary numbers here. 1, 2, 3. Okay, so projected cash flow divided by 1 plus the cost of capital, and I log it to the power of, to the first power, then to the second power, the third power, and so on. So just do copying and pasting. Okay, so what is the market value of the enterprise or the company or the project? It's just the sum of this. Okay, so 6.8 million, but in thousands. There's 6.87 billion. Interest-bearing debt, say interest-bearing debt in 2021, or you can use 2020, 2021. If you use 2021, for example, it would be this much. Yeah. So what is the market value of equity? The difference, right? The market value of equity. Sorry, so we need to. So maybe you can add back the cash if you want. So cash in 2021. Okay, so yeah, so the to get the equity, essentially the enterprise value, we add back cash and we minus the interest-bearing debt, so we get the market value of equity. If we give like marketability discount, because you are thinking that the value of the project or the company is lowered by its marketability challenge, right? It's quite challenging to market the project or the company. Let's say you give 20% discount, and it would be 20% of this. And premium control, for example, if you're selling, you want to buy a certain company or a project or a startup firm, but you don't gain control, so you own less than 51%, then you might want to give like premium control here, like 5% of this. So what is the intrinsic value of equity after the discounts, right? Marketability discounts and premium discount? So it would be minus this, this two. Okay, so 4.7 billion, and we divide it by number of shares outstanding. I think we saw it somewhere. Yeah, here. Okay, so it's about I don't know. Oh, okay. So we have to multiply it with thousands. One moment. So here, because it's in I think in million. So the number of shares outstanding is in million. So it's, yeah, we should put it. Yeah, so we get about three. Just to be precise, 315. 315 per share. That's the yeah, the what's it, the fundamental value per share, intrinsic value per share. Okay, and the other method is the free cash flow to equity. Free cash flow to equity holders. It's not exactly the same, but principle is quite similar. But now we do it differently. So free cash flow to equity holders means we are estimating free cash flow directly available to equity holders. So free cash flow to the firm is the free cash flow available to both investors, the creditors and stockholders. But free cash flow to equity holders is a free cash flow available to stockholders only. Okay? So free cash flow to equity holders is net income plus depreciation expense. Yeah, minus capex, minus the change in net working capital. Then yeah, plus or minus, maybe more appropriate to say. So plus new debt minus debt repayment. And plus horizon value. Okay, so slightly different, right? Net income plus depreciation expense. So we add back depreciation expense minus capex minus the change in net working capital plus the difference between new debt and debt repayment plus the horizon value. So let's try it here. We can begin with EBIT. EBIT of 21. Interest expense. Yeah, interest expense of 21. So earnings before tax. And the tax amount. Taxes of 21. And then earnings after tax. Yeah, earnings after tax is the net income, by another name for it. So net income. Then we do the adjustments again. We add back depreciation expense. Depreciation expense of 21. Okay, and then we deduct capex. And the best way to find capex is the cash flow statement. It's cash flow from investing activities. Cash flow from investing activities. Change in net working capital, the same thing here. The best way is to find it on the pro forma cash flow statement, the sum of all of this. The change in net working capital, so those changes. Okay, now increase or decrease in interest-bearing liabilities. So we have here a separate sheet for this one. So interest-bearing 21, and the difference between 21 to 20, the difference between 21 and 20, 22 and 21, and so on. Use the here at 21, we have two items, and then 20, we have two items also. Yep. Okay, so imagine again, right? The number or the amount in 21 was lower than that in 2020, meaning that we repaid more than adding new debt, right? So again, it's a positive relationship, right? If the debt amount decreases, it means that the cash is being disbursed, right? We are paying more than we are receiving new debt. But you see, in the second year, in 2022, the debt amount is 2022 is projected to be higher than that in 2021, meaning that there will be additional debt, more than debt repayment. Right? Okay, so similarly here, need the horizon value. So similarly, similar to the previous logic, what's the horizon value? Horizon value at time t should be the free cash flow to equity holders at time t plus minus t plus 1. Now we are using the cost of equity minus the constant growth forever, constant growth rate forever. So we can say this is free cash flow to equity holders, time t going by certain growth rate divided by cost of equity minus the constant growth forever. So what's the cash flow? Next cash flow. Again, the constant growth forever is 1.5. And the cost of equity is 10.10. So is the free cash flow to equity holders in 2029 will be the net income. We add back the depreciation expense. We look at the title there. net income, we add back the depreciation expense, minus capex, minus the change in net working capital, and plus or minus new debt, the difference between new debt and debt repayment. So this is the free cash flow to equity holders in 2029, growing by 1 plus constant growth forever. Then we divide it by cost of equity minus the constant growth forever. Okay, so we get a certain amount there, horizon value. Okay, so free cash flow to equity holders, and this is net income. We add back depreciation expense, minus capex, minus the change in net working capital, and then plus minus the difference between new debt and debt repayment and horizon value. And we get the free cash flow to equity holders for every year. And what's the present value? Then we need the imaginary. Right, divided by 1 plus cost of equity, but we need to log it, right, to the first power, just to the second power, and so on. All right, value of equity is simply the sum of this, sum of the present value. Okay, marketability discount, let's say 20%. Premium discount, premium control discount, say 5. And the fair value of equity would be this one cut by these two. And yeah, so the fair value of equity is estimated to be 3.7 billion. According to the free cash flow to the firm method, it was 4.7 billion. So there's a gap there. There's a difference. This one divided by okay. So we got 248 per share, as compared to 315 according to the free cash flow to the firm method. So there's a difference there, right? Different finding, but we just apply the two methods for valuation, right? Free cash flow to the firm and free cash flow to equity holders. So I hope this video could help your study to see a simple example, simple, some worksheets on free cash flow to the firm and free cash flow to equity holders methods. And we began from the assumption and making pro forma income statement, pro forma balance sheet, pro forma cash flow statement, and then the valuation process. Once again, I hope this video could help guide your study or accompany your readings by valuation. Thank you for tuning in, and hope to see you next time. Thank you.